The IPO we're looking at today is Litigation Capital Management. Ticker code will be LCA. Litigation Capital is planning to raise up to 15 million, and the funds will be used to repay debt and also to become an internally financed business. The company is predominantly focused on litigation, financing, mainly in the commercial space, but also class actions and insolvency matters. The company has managed 46 litigation projects since being founded in 1998, and they have a historical success rate of 78%. When it comes to assessing a company that is focused on litigation projects, we at Wise.owl usually look at three key indicators. That is the management team, the track record, and also the current order pipeline. The management team is strong. We have capital market experience and also a vast industry experience in the litigation space. The company has a strong track record operating since 1998, a historical success rate of 78%. It simply shows that management has a due diligence process in place that seems to be working. Over the last 5 years, a return on invested capital of 2.3 times was achieved. The order pipeline currently, the company has 14 litigation projects with a total valued size of 379 million. The point of the IPO is to help the company transition from an externally financed business to an internally financed business. That simply means that if they take on a litigation project, then the company will finance it themselves rather than having to borrow funds from an external party and then also pass on the economic benefits. So it will likely result in increased profitability for FY17. We're looking at the hurdles. One of the main issues with this IPO is not so much the company, but rather the industry it operates in. The industry is characterized by capital-intensive operations and also volatile earnings. So over the last 5 years, the earnings of LCA have been volatile. The company is very reliant on the outcome of each individual litigation case, having only dealt with 46 cases since 1998, and it simply means that if there are 2 or 3 bad outcomes or poor selection of litigation projects, then that will adversely impact earnings. Down the track, the company will obviously aim to pay a dividend, and that may also be restrained in case of a poor financial year. We have rated this float with 2 out of 5 points, which is roughly in line with our 12-month average. As mentioned earlier, we believe it ticks the main boxes of management team, track record, and also the current order pipeline. The hurdles are mainly industry specific. We believe there is also a high free float. We have almost 40% of unallocated free float that neither belongs to the IPO investors nor management, so that could impact the share price performance over the first 3 to 6 months. We will certainly monitor the stock over the upcoming year. We believe management needs to demonstrate sustainable earnings and also introduce a dividend within the next 2 or 3 years, and that should then help re-rate the share price. For the time being, we believe it is a solid float, but do keep in mind the industry-specific risks.